On most days, you can't quite pinpoint what exactly pushed the stock market up or down. Today was a little bit different. We know exactly what the moment was where we saw a crescendo of selling take place. We started off the day on a fairly solid footing, but as the day progressed, we started to hear news that President Biden was likely to suggest an increase on the capital gains tax for the ultra wealthy. And at that moment in time, the stock market started tumbling in a pretty major way, and we closed lower on all of our indices today, with most of them down about 1%. So we'll take a look at all of that activity, see if it affects our posture. Then we'll get into our trade application example, where I wanted to focus on a big consumer staples company that has been hitting recent 52-week highs for a sold put opportunity. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 22nd, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area and sign up for our email distribution list. We're also heavy users of Twitter. My handle is @BrandonVanZ, and we really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we have a group over on Facebook as well. Feel free to join that group at the web address you see in the logo in front of you. All right, let's jump into today's activity. As you can see, I've got chart 4B pulled up here in front of us, and this will be a view where we can look at all four major U.S. equity indices side by side. So that way we can kind of see if there's any differences. And as noted on Tuesday, there is a difference right now, and that difference is the Russell 2000 does have a bearish intermediate posture. Remember that we use the market forecast technical indicator to help us establish our posture for these videos. And that market forecast technical indicator are just those lines, those colorful lines you see below each of the charts there, which you can find on the Thinkorswim and TD Ameritrade platforms. Anyway, the main line that we look at is called the intermediate line, and that is also the green line. And in this case, you can see with the Russell 2000, the green line has been starting to trend lower here more recently. You can see the exact reading in the label at this moment in time is 51.27 and falling. And so that does give us a weekly bearish posture. Remember, if that level is falling and it's below 50, it does move to a strongly bearish posture. And the background color of the chart will turn to that dark pink shading. So expect that to happen tomorrow in all likelihood, since we're so close to 50 here on today's close. If we have any sort of a sell-off tomorrow, we are very likely to go to a strongly bearish posture on the Russell 2000 as soon as tomorrow. And then the background color of the chart will kind of look like what I'm circling right here, where you kind of see that difference between the light pink and the dark pink. Now, obviously, that doesn't always lead to some sort of disastrous scenario. It's just giving us a heads up that that is an area of weakness within the current marketplace. And while it figures itself out, if you are somebody that is more inclined to take bullish trades, you might be best served looking for other charts where the trends are a little bit stronger. Speaking of which, the other three charts that we do see on the board in front of us all continue to have strongly bullish postures. And all of them are strongly bullish because the green line is in the upper reversal zone. On the market forecast technical indicator, the upper reversal zone is above 80. So as you can see here with the S&P 500, it's at 91. On the Dow Jones, it's at 90. And on the NASDAQ Composite, it's at 88. Now, you'll see that all of them have falling lines, but remember, we do give these indices a bit of a grace period above 80, so they can be either rising or falling above 80 as long as they're in that kind of top 20th percentile. We do consider the market trends to be reasonably strong and the postures to be bullish at that moment in time. So that's kind of where we stand right now. With all of our charts, we have not hit a new high in the past week. Right? It was back here on April 16th that we hit a high on the S&P 500. It was the same day that we hit a high on the Dow Jones Industrial Average. With the NASDAQ Composite, we'd have to go all the way back here to February 16th. So it's been a little bit of a more difficult week. I think I heard them say on business television earlier today that this was shaping up to be the worst week since February on the broad market indices at this point. Again, not a disastrous situation. We had been a bit overheated to the upside, so these types of givebacks are perfectly natural. We are still very close to all-time highs on most of these indices here. It's just that we're taking a little bit of a break this week, a little bit of a time away from those strong trends that we had prior to this week. In terms of the other indications on the chart, I did want to point out a couple of other things which are on the top two charts here. So the S&P 500 and the Dow Jones were both down about 0.9% today. In fact, the NASDAQ was as well. So all three of those were down approximately the same amount. But one thing I will point out is that with the S&P 500 and the Dow Jones Industrial Average, you'll notice that their red momentum lines are both below 20. Now, the Dow Jones just barely got below 20. It ended at 19.93. So you're talking about like basically sitting right on 20. Nonetheless, it does qualify as what's known as a bullish intermediate confirmation signal. Now, as you've heard us say countless times, if you're tuning into these videos over the years, there are more ideal forms and less ideal forms. A bullish intermediate confirmation signal exists when the green line is considered bullish and the red line is in the lower reversal zone. And that is the case for both of these top charts. Intermediate confirmation signal, in this case a bullish intermediate confirmation signal, is meant to be a buy the dips philosophy. What it's kind of trying to tell us is that the intermediate trend posture is bullish. And I think we'd all agree, if we look at the S&P 500, that is a bullish chart that we're looking at there. And at the same time, we've got a brief moment where we've had a little bit of a pullback here. So that's what the red line is telling us. Remember, the red line is much more sensitive than the green line. So it's going to move up and down much more quickly. So the green line in the upper reversal zone is telling us the trend is still strong. The red line in the lower reversal zone is telling us that at this exact moment in time, we've had a little bit of a pullback. And so those can oftentimes lead to opportunities for you to buy securities at cheaper prices than you would have been able to otherwise. So in other words, it's a buy the dips mentality if you assume that those trends will continue to go up from the intermediate term perspective going forward. But you'll also notice that the blue near-term line in both of these charts cases are between 55 and 60. So with the S&P 500, it's at 57, and with the Dow Jones, it's at 59. And while the blue line is not technically part of the bullish intermediate confirmation signal, we tend to use it to try to determine if we have more ideal or less ideal setups. When the blue line is below the 50th percentile but still above the 20th percentile, that is a healthier exhale. Right here, we've had a little bit of an exhale, but it hasn't been a strong one where we've seen extremely big givebacks in the price action up above. It's been a decent one. Again, it's a week ago since we had a high, so we're down a good 55 or 60 points thereabouts on the S&P 500. But if that blue line would have been below 50 and 20, we would have seen that price action even a little bit lower, where maybe your downside risk in any future trade setup would be more limited than it is right now. Right now, you're recognizing the signal is set up, but you also have to recognize that this hasn't been the deepest of exhales, and therefore you still might have another day or two of selling in front of us. So, in both of these cases, we have bullish intermediate confirmation signals, but neither one of them are considered of the more ideal variety there. All right, let's go ahead and take a look at our next chart. In this case, we'll take a look at our 3 green arrows chart setup. This will be chart 4D. And as we're looking at this chart, it's basically the same story as what I mentioned on Tuesday, which is the Russell 2000 has 3 red arrows, 1, 2, 3. And the other charts all have a mix of green and red arrows. So that's why the background colors of the other charts are white currently, whereas the background color of the Russell 2000 has that pink shading here on chart 4D, for those of you that are premium members following along at home. And so what that is telling us is that this trend is not ideal for those of you that are looking for bullish trend trades going forward. It doesn't mean that it can't happen at some point going forward. It's just that we would like to see a firming up of the chart before being willing to take that bet. And right now, these three different technical indicators, the 30-day moving average, the MACD histogram, and the stochastics, are all giving us some elements of bearishness right now. So we want to be a little bit more cautious if we were to be doing bullish trend trades within the small cap universe of the Russell 2000. We talked about the small caps in length yesterday during my factor-based swing trading class, talking about kind of the loss of that momentum that we've been seeing in some of those higher octane areas like the Russell 2000 and other small cap areas. And so right now this is a market that seems to prefer value-oriented areas and maybe even a bit of dividend and quality areas, and it's not willing to take a lot of risk at this moment in time. Another thing to be aware of in terms of the conversation with the possible increase in the future of capital gains taxes is remember that the NASDAQ has the potential to get hit a little bit harder there because it's most of those FANG stocks that have gone up so dramatically in prior years. And so it is possible that all of those multimillionaires out there who these new tax rules might affect are the ones that have been sitting on those massive gains out of stocks like Amazon and Facebook and Apple and Netflix and Google. And so be on the lookout for that possibility. If that hike in capital gains tax is actually going to be pushed through, you might see a little bit of extra sell-off potential in the NASDAQ composite because of what types of stocks have done well in the past where people are sitting currently on huge capital gains. Let's go ahead and now take a look at our 1040 crossover method, and this is chart 4C. And as we're looking at this particular chart here, you can see that everything seems to be going swimmingly from a longer term perspective. So while we are exhibiting a little bit more weakness in the short term on the Russell 2000, we are not necessarily experiencing a major give back from a long term perspective. And what we're doing in this particular chart setup is trying to evaluate whether the 10-week moving average is crossing the 40-week moving average. And you can see in all four of these charts cases that we have green background colors telling us that the orange line is above the blue lines, the orange line being the 10-week moving average and the blue line being the 40-week moving average. And all of these gave us bullish crossovers many months ago. In fact, in the case of the NASDAQ, we're about at our 1-year anniversary here. That'll hit in just a couple of weeks. And so remember, this is a chart setup here where we're looking at 3 years worth of information, and it does not have a very sensitive approach to changes within the market for better or for worse. In this case, that lack of sensitivity has been a huge benefit because, of course, we've had other skirmishes and pullbacks along the way over the past year, but what this chart has allowed those of you that practice it to maintain is bullishness within your longer-term portfolio, because even if the stock market sells off for a week or two along the way, it's not enough to actually see those weekly moving averages cross. Now, as I've been pointing out in this presentation in recent weeks, you will want to be aware that while we do have bullish crossovers that exist right now in all four of these charts, the Russell 2000 here clearly is seeing a rolling over of that PPO. And remember, the PPO is effectively measuring the distance between the 10-week moving average and the 40-week moving average here. So when this green line down below starts to roll over like it appears like it is right now, it's saying that this orange line is going down towards that blue line. And therefore, we're seeing a loss of momentum in the short term. Whereas with the Dow Jones and with the S&P 500, those green lines are still going up, telling us that in the short term, we're actually seeing an acceleration of some of that bullishness that exists out there. So again, right now we are seeing that the Russell 2000 is our laggard in this market, and then the NASDAQ is kind of after that. Otherwise, the two large cap indices up above, where you have the larger, higher quality blue chip types of companies, are the ones that are holding up in this market quite a bit better. Let's go ahead and do some 12 grid analysis now. And as I do that, I'm going to come over here to chart 5A, which is our asset class 12 grid. Now, a reminder here that the background colors of these 12 grids will tell us whether we have a bullish or bearish posture using the market forecast intermediate term line. And for those of you that are premium members of Market Scholars, remember, if you ever wanted to see the actual market forecast technical indicator, you can always right-click on the charts and then see it down below. So as an example, if we wanted to look at gold here and I right click on it and go to maximize sell, it then will show me a blown up version of that miniature chart, and down at the bottom you will then actually see the indicator itself. But when you're in kind of a minimized view like we normally are with the 12 grid, how you can judge whether you have bullishness or not is also not just the color of the background color there, but also the label will tell you where that intermediate line is. So like in the case of gold here, the intermediate line is at 93 and falling. Now again, remember, anything above 80 is considered strongly bullish. So even though in this case it's falling, we give it that grace period until it falls below 80. And then at that point, if it does happen, it would move to a bearish posture. But right now, we continue to have a bullish posture on gold. And as mentioned in recent presentations, this has been a rather impressive turnaround. We've been kind of monitoring it here for the last couple of weeks in particular as it got up and over this prior resistance candle right here. And of course, along the way, not only has it continued to go higher, but it's actually taken the 30-day moving average up with it. So the moving average was once red, telling us that price was below the falling moving average. It turned to yellow when price went above the falling moving average, and now it's transitioned to green now that price is above a rising moving average. That's a nice, healthy transition right there that gives us the impression that there could legitimately be a trend change taking place here. And of course, you know, we're hoping for that in this particular presentation because I put on that bullish trade on the gold mining stock here a couple of sessions ago. So we'll continue to monitor that. Gold was down a little bit today after producing an overbought cluster signal yesterday. But remember, when we get those overbought cluster signals early in the move, it doesn't have to mean that a big sell-off is in store. It, in fact, can tell us that there's a lot of strength behind that move. So don't let that red dot scare you in this particular case. If the move was already extended, then yes, that has to become a concern. But right now, this is really early in that potential trend reversal there. So you could actually look at it as a slight benefit. Other charts that look reasonably interesting here, I would identify as long-term U.S. Treasuries. It's been a while since I've made that comment. Treasuries have been really struggling in 2021 as a result of the rising interest rate environment. But with interest rates rolling over here in the last 2 or 3 weeks, you can see that U.S. long-term Treasuries have stabilized, at least in price there. And similar to gold, we now see a situation where that red moving average transitioned to yellow, which has now transitioned to green. There could be a potential trend reversal on our hands here with long-term U.S. Treasuries. Now, between the two, I personally like gold for the long term better than bonds. I do think that bonds over the long term will struggle to keep up with other risk-related assets because interest rates are still historically low. Nonetheless, these financial assets don't just usually move in a straight line. So this could very well be a time where too many people got on the wrong side of the trade, and we are now seeing the unwind of that particular situation. And in this case, it's possible that U.S. long-term Treasuries end up having either a sideways or a slightly higher move here, where you might be able to make a little bit of money selling bull put spreads or something along those lines. By the way, the U.S. Treasury, the 10-year U.S. Treasury did close with a yield of 1.55% here today. You will notice that up here at the top level, we did see that the U.S. market did fall more than the other markets here today. And so just be aware that the foreign developed markets were down 0.33%, and the emerging foreign markets were down 0.35%. Now, between those two charts, it should be clear that the better trending chart is the one that is the developed market. So If you're looking at markets like Germany or the United Kingdom, maybe even France, those are some of the areas that still have reasonably strong charts. Over here on the emerging market side of the equation, we've seen progress on the chart. We're back above a rising moving average, but the background color is still light pink, telling us that we have that weekly bearish posture. So perhaps a turnaround potential there, but not necessarily having that momentum and the wind in the sails the way that the foreign developed markets do. So we'll keep our eye on that. But right now, if you're looking for trends, you're probably better off in Germany and the United Kingdom than you would be in China and India. Let's go ahead and take a look at our next set of 12 grids. And in this case, we'll take a look at the U.S. sectors 12 grid, and this will be chart 5C. And as you can see, things are largely the same as where they were a couple of days ago when we reviewed this data, meaning that energy is the only sector here in the United States from a market cap weighted perspective. And by the way, we had about a 40 to 45 minute discussion in my question and answer session earlier today regarding the understanding of market cap weights versus equal weights and how we might want to think about that as top-down trend traders. So if you're interested in that conversation and you're a premium member of Market Scholars, that recording has been posted to our calendar and you're welcome to check it out. It's actually the very first question of the session. So anyway, great discussion there. But in this case, when we're looking at chart 5C, remember that these are the market cap weighted versions. So in the case of something like XLE, is going to be heavily influenced by just two stocks, Exxon and Chevron. Regardless, you can see here that there's been enough wear and tear on this chart where we do have this dark pink background color telling us that we have a strongly bearish posture. And energy was down another 1.17% today, and it's actually the fifth out of the last 6 days to the downside, with yesterday being the only exception to that. And you can see kind of the opposite transition taking place here on the 30-day moving average compared to what I just showed you on gold and U.S. Treasuries. In this case, we had a strongly uptrending chart with that green moving average transition into yellow, now transition into red. So we went from having price above a rising moving average to price below a rising moving average to now price below a falling moving average. And generally speaking, that's a little bit more nerve-wracking because you can see that it's kind of using that moving average now as resistance, whereas once upon a time it might have used it as support. So until we learn otherwise, we've got to be very careful around those oil and gas companies as they've started to really start to transition lower. I mentioned on Tuesday that this candle was an important one because we broke below that prior double bottom right there. And while yesterday there was a little bit of a reversion to the mean type of a move, today we gave it right back and once again closed below that prior double bottom formation right there. So energy stocks have been a little bit more difficult to trade here, at least on the long side of the market recently. There's been a lot better trends out there. Now, if you look at the other charts that are on the board, you'll notice that we did have a clean sweep for the bears. In other words, from a one-day price action, all 11 of these sectors were down today. So, this whole capital gains potential tax news really did affect all sectors. It just affected them at various degrees. And you'll notice that the areas that were down more than 1% were the financials, technology, discretionary, materials, and the aforementioned energy. So those were the areas that got hit a little bit worse. Naturally, on a day of selling, you would figure that the areas that would hold up a little bit better would be the more defensive areas of the market. And that is kind of what we saw here today once again. Down on the bottom rung, we have our defensive sectors. They were all down today, but they were down less than a lot of those other cyclical areas. So healthcare was down 0.45%, and real estate was down 0.43%. So those were actually your two leaders here today. I've been tweeting a lot about pharmaceutical stocks for those of you that are interested in those types of companies, particularly from their dividend paying capacity. So feel free to check my Twitter feed for that information. But we've seen a very nice move in a lot of these healthcare companies in just the last couple of weeks here. So, don't fall asleep on some of those more mundane areas of the market. We're actually seeing some pretty robust price activity. You'll notice that the intermediate line on healthcare is now at 97. Same thing goes for real estate. So those two areas have turned into some fairly strong intermediate postures all of a sudden as well. All right, let's go ahead and get into our trade application example. And for this particular trade application example, I'm going to take a look at a couple of different charts. Let's go ahead and just pull up chart 3A to begin with. And as a reminder, the trade has already been done. I always do the trades during the market session and then send out all of the trade information, the confirmations and the screenshots and all of that to all of you who are premium members of Market Scholars. So that way you can consider the trades before the market closes, and everybody else who's just watching the free YouTube videos would then have to consider it for the following day's opening activity. But the trade is done. Let's go ahead and explain what it is that I did here today. In this case, I opted to go with a bullish trade on Philip Morris. Now, maybe this isn't the best of charts to look at in this case. Let's go ahead and pull up a trend trading chart. So let's use chart 1A first. And I'll show you that on ticker symbol PM, which is Philip Morris International, this is a strongly trending security right now. A lot of people have been talking about tobacco stocks here in the last week or two because of these rumors floating around that the Biden administration might be pushing for a reduction in the nicotine levels of cigarettes here in the United States. So a lot of those tobacco companies got hit earlier this week initially on that news. We spent a lot of time in my question and answer session earlier today talking about Philip Morris and Altria and what that potential regulation might mean for them. So again, if you're a premium member of Market Scholars, feel free to check out my recording from my question and answer session earlier today if you want my deeper insight on that particular subject matter. But in this case, I just wanted to point out the fact that we have a strongly trending security right here, despite some of the negative news headlines that's been hitting the tobacco space here recently. You can see that we have a 5 green arrows signal. That's what that background color in the light green is telling us. We've got a strong war score up here at basically at its highest level on the chart. That WAR just stands for weighted aggregate returns. It's a way for us to establish price over multiple time periods and whether those prices are strong or weak. We can also see a green arrow here on the MACD histogram, stochastics. You can see that the market forecast intermediate line is in the green in the upper reversal zone there. And so that's telling us that we have a strongly bullish posture from a trend trading perspective on Philip Morris. You can also see that we have a intermediate confirmation signal today on this one with the green line in the upper reversal zone, the red line in the lower reversal zone there. And then you can also see down below that this stock is one of the strongest stocks in the market right now on a relative basis. So when you're looking at strength relative to the S&P 500, the consumer staples sector, or the tobacco industry group, Philip Morris does perform well versus all three of those categories with these colored lines up here near the 100th percentile. So this is a strongly bullish candidate that we're dealing with here with Philip Morris, and they did just report their earnings here a couple of days ago, where they did beat the analyst expectations pretty easily. Now remember, Philip Morris International sells Marlboros and other tobacco products internationally. They do not sell them here in the United States. And so any potential regulation that would be pushed through in the United States should not affect them directly, even though they might go down or up in sympathy with other players like MO. But in this case, their earnings wouldn't be directly disadvantaged if that did come to fruition, which is likely years away if it actually would take place. But $1.55 did beat their prior quarter of $1.31, which also beat the analysts' expectations there. So this is a business that continues to be reasonably strong, and it is slightly outperforming the S&P 500 over this chart's time period. Now I want to show you a slightly different chart. This is the chart that we use for our dividend classes. Naturally, Philip Morris is a very steady dividend-paying company, and it has a yield of over 5% at this moment in time. So a lot of people who dabble in the tobacco stocks are interested in the income that it produces. And on this particular chart, 2A, you can see here that Philip Morris has a yield of 5.11%. Now, we use this particular chart in my dividend growth investing classes that I teach on Tuesday morning as a way for us to gauge whether we have better than average prices or worse than average prices when we start a long-term position in a security. And, I'm not going to explain the whole thing here. It would take too long, but just understand that when the stock is trading in this blue zone down below, we view that stock as reasonably attractive on a historical yield basis, whereas when it's trading up in the orange zone up above, we view that as reasonably unattractive from a yield basis. So in other words, for the last couple of years, Philip Morris has been an interesting choice to purchase for the long term if you're comfortable, of course, owning a tobacco company. And not all of you may be. So each one of you has to make a decision on that. But what I wanted to point out here is, of course, the last 6 months or so, we've had this big surge in Philip Morris from about $70 here in late October to $94 here in real time. So that has been a very strong move for a traditionally slow-moving company. And what has happened is it has moved the stock out of the blue zone. And so when this happens, we generally look at charts like this in my Monday afternoon options for long-term investors class, where we look to sell puts on the underlying security, where we can sell a put strike price that takes us back into the blue zone. In other words, we would no longer be willing to buy PM here for a dividend purpose. You might buy it as a trend trade or something else, but for dividend purposes, now that it's no longer in the blue zone, we would no longer be interested in buying it here at 94. But if it fell back into the blue zone, then yes, we might very well be interested in buying it once again. And so by selling a put with a strike price that's back in the blue zone, we can kind of emphasize a bullish type of a trade on a longer term security and allow us to have the mindset that if push comes to shove, we would be willing to buy 100 shares of Philip Morris if it fell down to our strike price or lower on expiration day. And if that doesn't happen, let's say that Philip Morris just keeps on going up just like it has for the last several months. Well, if that's the case, at least we have a bit of a partying gift in the form of the credit that we receive up front when we sell that put. That's our money to keep. And so the strike price that I selected was the $87.50. And I believe that was in the month of June. If you need the fill prices and contracts and all that kind of stuff, again, if you're a premium member, the benefit you have is being able to check that Telegram for all of that information. But that's kind of the idea. If the stock falls back down into this blue zone here, the willingness to take ownership of it at that price. And if it does continue to go up, then we get to keep all that money that we just generated as a credit here when we sold that put earlier today. Okay, so that's the idea of a consumer staples giant that is in a strong price trend right now, but is just emerging out of the blue zone on the dividend stair-step charts and sets up a potential options for long-term investors sold put situation right here. And I hope you enjoyed that trade example from kind of multiple vantage points. If you did, I have one favor to ask of you. Please click like for me there on Twitter if you want to see us do these types of examples again in the future. You can do that by going over to my Twitter timeline or just doing it on our website below the video or even in the description area of the YouTube videos for those of you that watch them over there. You can also find the Twitter link in the emails that we send you from our notifications. So 4 different ways to accomplish that task, but it does go a long way for us, and we really appreciate those of you that help us along with that effort. So that's what I had for you here today. Of course, the big story being the capital gains tax, or at least the potential of that, and a little bit of a sell-off there in the market. But at this point, it's not a big deal. We still have bullish postures on 3 out of the 4 major indices, but we'll keep our eye on that story, and if things change, you'll hear it here first. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.